Today is not an easy day. I'll be talking about a book which I have been reading till late last night because I want to keep uploading regularly. The book is called The Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free. And it is written by, I hope that I'm pronouncing this right, Ellen Hodgson Brown. It talks about the financial system, as you might have guessed, but there is more to it. Now, I'm going to try and explain what this book says in my own words. Please don't laugh. This book argues mainly that, contrary to popular belief, money isn't created or issued by governments in any way. It focuses on the government of the USA and on the financial system in the USA, but it kind of talks about the way that it looks in most countries around the world. Instead, money comes into existence as debt, government debt, which they have to central banks. The central or national banks, and let's assume that they mean the same thing for the sake of this video, create money quite literally out of thin air and lend it to governments. This never gets paid back in full. Instead, it becomes something that we call public debt. But the banks require interest to be paid back. Apparently, that interest is meant to be the income tax. It is supposed to cover that, and not the things that we think it's meant for. And then that's not the end of it. The book also argues that the private banks, the banks which customers use on a daily basis, are the main creators of money as well. And it says that every time a bank makes a loan of any kind, so anytime money leaves the bank except for customers' withdrawals, I guess, that's all brand new money. And since it's quite uncommon to take out large loans in cash now, it doesn't take much to orchestrate that really, because it all happens on the screens of the computers, not even in books anymore. These are just some of the things, and to give you a better understanding, I'll read you the points listed in the introduction chapter now. Here we go. The Federal Reserve is not actually federal. It is a private corporation owned by a consortium of very large multinational banks. Except for coins, the government does not create money. Dollar bills are created by the private Federal Reserve, which lends them to the government. Tangible currency, meaning coins and dollar bills, together make up less than 3% of the US money supply. The other 97% exists only as data entries on computer screens, and all of this money was created by banks in the form of loans. Furthermore, it says the money that banks lend is not recycled from pre-existing deposits. It is new money which did not exist until it was lent, which is what I said before. Now listen to this. 30% of the money created by banks with accounting entries is invested for their own accounts. The American banking system, which at one time extended productive loans to agriculture and industry, has today become a giant betting machine. By December 2007, an estimated 681 trillion were riding on complex high-risk bets known as derivatives, 9 times the annual output of the entire world economy. These bets are funded by big US banks and are made largely with borrowed money created on a computer screen. Derivatives can be and have been used to manipulate markets, loot businesses, and destroy competitor economies. The US federal debt has not been paid off since the days of Andrew Jackson. Only the interest gets paid, while the principal portion continues to grow. The federal income tax was instituted specifically to coerce taxpayers to pay the interest due to the banks on the federal debt. If the money supply had been created by the government rather than borrowed from banks that created it, the income tax would have been unnecessary. Contrary to popular belief, creeping inflation is not caused by the government irresponsibly printing dollars. It is caused by banks expanding the money supply with loans. Most of the runaway inflation seen in banana republics has been caused not by national governments overprinting money, but by global institutional speculators attacking local currencies and devaluating them on international markets. The same sort of speculative devaluation could happen to the US dollar if international investors were to abandon it as a global reserve currency, something they are now threatening to do in retaliation for what they perceive to be American economic imperialism. And then they say, there is a way out of this morass. The early American colonists found it, and so did Abraham Lincoln and some other national leaders. The government can take back the money issuing power from the banks. Shocked yet? Oh, there's so much more. Now, because the book is full of historical details, names of people, organizations, processes, etc., things that hardly anyone has time and room for, I've been highlighting all the passages that I thought were meaningful. And I was planning to grab my Kindle, read and comment on them, and yeah, if that's alright with you. I'll be reading a lot, and some of these words won't be the words of the author of the book, but will just be quotations of other people. But I just can't be bothered to give you all the names because that would take us ages, so sorry. So I'll be going one by one, and some of these might be taken out of context, but I'll try to remember why I highlighted them, and I'll try to comment on them, etc, etc. Alright, let's start. So I have a passage here that says the entire US money supply now consists of debt to private banks for money they created with accounting entries on their books. It is all done by sleight of hand, and like a magician's trick, we have to see it many times before we realize what is going on. But when we do, it changes everything. All of history has to be rewritten. Another passage. Banks create money. That is what they are for. The manufacturing process to make money consists of making an entry in a book. That is all. Each and every time a bank makes a loan, new bank credit is created, brand new money. And then it says, when a bank makes a loan, it simply adds to the borrower's deposit account in the bank by the amount of the loan. The money is not taken from anyone else's deposit. It was not previously paid to the bank by anyone. It's new money created by the bank for the use of the borrower. Another passage, if governments everywhere are in debt, who are they in debt to? The answer is that they are in debt to private banks. The cruel hoax is that governments are in debt for money created on a computer screen. Money they could have created themselves. Economics is a dry and forbidding subject that has been made intentionally complex by banking interests intent on concealing what is really going on, and that is something that I agree with 100%. I don't think people that have education, proper education, that are in that field even understand everything that is being said in this book. Now this, I'm not sure what kind of moment in history this is talking about, but there are some smart things said in here. So the fragment says, the economy was deep in depression, but the country's farmlands were still fertile and its factories were ready to roll. Its entranced people merely lacked the paper tokens called money that would facilitate production and trade. The people had been deluded into a belief in scarcity by defining their wealth in terms of a scarce commodity, gold. The country's true wealth consisted of its goods and services, its resources, and the creativity of its people. So this probably talks about the gold standard that was, the standard policy back in the day, and it probably talks about a time when gold became scarce, and how all of that just makes no sense whatsoever. Then in a different chapter, something very interesting is being said, and it goes like this. When a bank provides you with $100,000 mortgage, it creates only the principal, which you spend and then circulates in the economy. The bank expects you to pay back $200,000 over the next 20 years, but it doesn't create the second $100,000, the interest. Instead, the bank sends you out into the tough world to battle against everybody else to bring back the second $100,000. The problem is that all money except coins now comes from banker-created loans. So the only way to get the interest owed on old loans is to take out new loans, continually inflating the money supply. Either that or some borrowers have to default, meaning they have to never pay back what they borrowed. And then it says, greed and competition are not a result of immutable human temperament. Greed and fear of scarcity are in fact being continuously created and amplified as a direct result of the kind of money we are using. We can produce more than enough food to feed everybody, and there is definitely enough work for everybody in the world. But there is clearly not enough money to pay for it all. The scarcity is in our national currencies. In fact, the job of central banks is to create and maintain that currency scarcity. The direct consequence is that we have to fight with each other in order to survive. Now, this particular fragment, I'm not sure what this is talking about. I think it's talking about the system that they had in medieval England. But it's very interesting, so just let me read it and you'll see for yourself. So, it says, rather than having to borrow the money lender's gold, the people relied largely on interest-free tallies. Unlike gold, wooden tallies could not become scarce, and unlike paper money, they could not be counterfeited or multiplied by sleight of hand. They were simply a unit of measure, a tally of goods and services exchanged. The tally system avoided both the depressions resulting from a scarcity of gold and the inflations resulting from printing paper money out of all proportion to the goods and services available for sale. Since the tallies came into existence along with goods and services, supply and demand increased together, and prices remained stable. The tally system provided an organic form of money that expanded naturally as trade expanded and contracted naturally as taxes were paid. Bankers did not have to meet behind closed doors to set interest rates and manipulate markets to keep the money supply in balance. It balanced the way a checkbook balances as a matter of simple math. The system of government-issued tallies kept the British economy stable and thriving until the mid-17th century, when Oliver Cromwell needed money to fund a revolt against the Stuart monarchy. Now, this is even more interesting. This is the next passage that I highlighted, and it says the New York Federal Reserve has now deleted its earlier explanation from its website, but as it explained the money-creating process in 2004. Reserve requirements are computed as percentages of deposits that banks must hold as vault cash or on deposit at a Federal Reserve bank. As of December 2006, the reserve requirement was 10% on transaction deposits, and there were 0 reserves required for time deposits. If the reserve requirement is 10%, for example, a bank that receives a $100 deposit may lend out $90 of that deposit. If the borrower then writes a check to someone who deposits the $90, the bank receiving that deposit can lend out $81. As the process continues, the banking system can expand the initial deposit of $100 into a maximum of $1,000 of money. Now again, talking about deposits, there's a fragment that says, at one time, a bank's reserves consisted of gold bullion, which was kept in a vault and was used to redeem paper banknotes presented by depositors. The fractional reserve banking scheme concealed the fact that there was insufficient gold to redeem all the notes laying claim to it. Today, Federal Reserve notes cannot be redeemed for anything but more paper notes when the old ones wear out. Yet, the banks continue to operate on the fractional reserve system, lending out many times more money than they actually have on reserve. The reserve requirement itself is becoming obsolete. According to a press release issued by the Federal Reserve Board on October 4, 2005, no reserves would be required in 2006 for the first 7.8 million of net transaction accounts. At a 0% reserve, there is no limit to the number of times deposits can be relent. In practice, the connection between reserve requirements and money creation is not nearly as strong as the exercise above would suggest. The Federal Reserve operates in a way that permits banks to acquire the reserves they need to meet their requirements from the money market, so long as they are willing to pay the prevailing price for borrowed reserves. Consequently, reserve requirements currently play a relatively limited role in money creation in the United States. And then it says, it seems that banks can conjure up as much money as they want, whenever they want. If a bank runs out of reserves, it can borrow them from other banks or the Fed, which creates them out of thin air in open market operations. Now again, here another passage says, the illusion is that a bank is an institution that accepts deposits to build up reserves and then on-lends them at a margin to make money. But this is completely incorrect depiction of how banks operate. Bank lending is not reserve constrained. Banks lend to any credit-worthy customer they can find and then worry about the reserve positions afterwards. If they are short of reserves, they can borrow from each other in the interbank market, or ultimately, they will borrow from the central bank through the so-called discount window. Then there's a passage that says, but how, you may ask, can banks go bankrupt? Don't they have the power to create money out of thin air? Why doesn't a bank with bad loans on its books just write them off and carry on? Well, British economist Michael Rowbotham explains that under the accountancy rules of commercial banks, all banks are obliged to balance their books, making their assets equal their liabilities. They can create all the money they can find borrowers for, but if the money isn't paid back, then the banks have to record a loss, and when they cancel or write off debt, their total assets fall. To balance their books by making their assets equal their liabilities, they have to take the money either from profits or from funds invested by the bank's owners, and if the loss is more than the bank or its owners can profitably sustain, the bank will have to close its doors. But it turns out the banks have found a way to get around that too. To know how, you just have to read the book. I won't be reading it. Now, this is a passage from a different chapter, and it talks about it talks about currencies and exchange rates and everything that's happening there. And so listen to this. While economists debate the fiscal pros and cons of floating exchange rates, from a legal standpoint, they represent a blatant fraud on the people who depend on a stable medium of exchange. They are as much a fraud as a grocer's scales with a rock on it. If a farmer's peso was worth 30 cents yesterday and is worth only 5 cents today, his dozen eggs have suddenly shrunk to 2 eggs, his dozen apples to 2 apples. The very notion that a country has to defend its currency shows that there is something wrong with the system. Inches don't have to defend themselves against millimeters, but peacefully coexist with them side by side on the same yardstick. A sovereign government has both the right and the duty to calibrate its medium of exchange so that it is a stable measure of purchasing power for its people. And there's another very simple and obvious conclusion, but a very important one in this book. It says, as long as the international monetary system was based on gold, a nation which cornered gold could impose its will on those who lacked it. I think this is pretty clear. Then there's a passage here that talks about third world countries, and it says the rampant runaway inflations of third world economies are widely blamed on desperate governments trying to solve their economic problems by running the currency printing presses, but closer examination generally reveals other hands to be at work. What causes merchants to raise their prices is not a sudden flood of money from customers competing for their products because the money supply has been pumped up with new currency. Rather, it is a dramatic increase in the merchant's own costs as a result of a radical devaluation of the local currency, and this devaluation can usually be traced to manipulations in the currency's floating exchange rate. And this book also states a very important thing. It says, when workers and raw materials are available to increase productivity, adding money does not increase prices, it increases goods and services. Supply keeps up with demand, leaving prices unaffected. And I do believe that that is true because money often acts as a, it just puts people to work and it just gets everything going again. It doesn't necessarily have to inflate the prices. If workers and raw materials are available to increase productivity, then adding money to the system will not cause inflation, contrary to popular belief. And then there's a passage about mortgages, which is very interesting for young people or for anyone that's looking to have a house of his own. And it says, loans are structured so that the borrower who agrees to a 30-year mortgage at a fixed rate of 7% will actually pay about 2.5 times the list price of the house over the course of the loan. A house priced at $330,000 at 7% interest would accrue $460,000 in interest for a total tab of $790,000. The bank thus actually gets a bigger chunk of the pie than the seller, although it never owned either the property or the loan money, which was created as it was let. And home loans are completely secured, so the risk to the bank is very low. The buyer will pay about 2.5 times the list price to borrow money the bank never had until the mortgage was signed, and if he fails to pay the full 250%, the bank may wind up with the house. Now, this is a very interesting passage. Credit and debt cancel each other out and merge back into the great 0 point field from whence they came. To avoid that result and keep money in the economy, new debt must continually be created. When commercial borrowers aren't creating enough money by borrowing it into existence, the government must take over that function by spending money it doesn't have, justifying its loans in any way it can. Keeping the economy alive means continually finding ways to pump newly created loan money into the system, while concealing the fact that this money has been spun out of thin air. These new loans don't necessarily have to be paid back. New money just has to be circulated, providing a source of funds to pay the extra interest that wasn't lent into existence by the original loans. Now, this passage talks about something called derivatives, and it actually explains what they are. Very simply. So it says, while derivatives may appear to be complex instruments, the concept is actually simple. They are insurance contracts against something happening, such as interest rates going up or the stock market going down. To me, that means that they are bets, and that the words that we've heard at the beginning of this, that the whole thing is a big betting machine, the whole system, are well, they must be true. Which means that the whole financial system is a large casino, and that's not fun. Another interesting passage. I know that there has been a lot, but this is the only way that I can talk about this book. Really, I can't possibly repeat these things or say them in my own words. I just have to read them. So this says, the prevailing scarcity mentality focuses on the shortages of oil, water, and food. But the real shortage, as Benjamin Franklin explained to his English listeners in the 18th century, is in the medium of exchange. If sufficient money could be made available to develop alternative sources of energy, alternative means of extracting water from the environment, and more efficient ways of growing food, there could be abundance for all. The notion that the government could simply print the money it needs is considered unrealistically utopian and inflationary, yet banks create money all the time. The chief reason the US government can't do it is that a private banking cartel already has a monopoly on the practice. Another passage, for centuries, central banks have been robbing the common man by the way they put new money in circulation. Rather than divide the new cash among the people, they lend it through the banking system at interest. This practice, he argues, someone, I don't know who, makes the central banks the money's owners and makes everyone else their debtors. He goes on to conclude, again this person, that this debt-based money has roughly half the purchasing power it would have if it were issued directly to the populace free. Another passage, when old loans get paid off, that money is extinguished. So new loans must continually be taken out just to keep the money supply at its current level. Do you understand this? If all money comes from loans from the banks, if everyone paid them back, then there would be no money in the system. And since banks create the principal, but not the interest necessary to pay off their loans, someone somewhere has to continually be taking out new loans to create the money to cover the interest due on this collective debt. Now this I just love. This is by Sheldon Emery from the book called Billions for the Bankers, Debts for the People. And this is a quote, and it's just so funny. It's tragic, but it's funny. It says, "It is as ridiculous for a nation to say to its citizens, you must consume less because we are short of money, as it would be for an airline to say, our planes are flying, but we cannot take you because we are short of tickets." Don't you just love that quote? Now, this passage is about a local exchange trading system, a computerized system for recording transactions and keeping accounts, apparently built by Michael Linton in 1982. He's Canadian, that guy. And it says Linton had redefined money. In his scheme, it was merely an information system for recording human effort, which is what I think money should be. And a let's credit, which is the name of this currency, comes into existence when a member borrows the community's credit to purchase goods or services. The credit is extinguished when the member gives goods or services back to the community in satisfaction of his obligation to repay the credits. The exchange operates without any form of backing or reserves, Like the tally system of medieval England, it is just an accounting scheme tallying credits in and debits out. Let's credits cannot become scarce any more than inches can become scarce. They are tax-free and interest-free. They can be stored on a computer without even printing a paper copy, because they are simply information. That is all they are. In a website called Travel Without Money, Australian enthusiast James Tarris tells of his personal experiences with the Let's system. At a time when he had quit his job and was watching his money carefully, he attended a Let's group meeting in his local community where he learned that he could obtain a variety of services just for contributing an equivalent amount of his time. The result was the first and best professional massage he had ever had, a luxury for which he could not justify paying $60 cash when he was gainfully employed. He paid for this and other services by learning various internet and desktop publishing skills and contributing those skills to the group, something he quite enjoyed. Which I think is very similar to what I would create if it was up to me to just create the whole system all over again. I think I would make something like that because that makes people happy because they get to do something that they're good at, something that they're meant to do, and all the ridiculous things that are, you know, part of our current systems are not part of this system because it's very simple and it would probably make people a lot happier, a lot less stressed, and yeah. And then later on in the book it says local exchange systems, like the one that I've just talked about, demonstrate that money need not be something that is scarce or for which people have to compete. Money is simply credit. Credit can be had without gold, banks, governments, or even printing presses. It can all be done on a computer if we want to do it that way. The book also talks about something called the impossible contract problem, which is something that I've already mentioned, but it says that it is the problem of finding principal and interest to pay back loans in a monetary scheme in which only the principal is put into the money supply, right? So this makes no sense whatsoever. Now again, there's a passage about gold, and it says the gold bugs countered that currency backed only by the national credit was too easily inflated by unscrupulous politicians. Gold, they insisted, was the only stable medium of exchange. They called it sound money or honest money. Gold had the weight of history to recommend it, having been used as money for 5,000 years. It had to be extracted from the earth under difficult and often dangerous circumstances, and the earth had only so much of it to relinquish. The supply of it was therefore relatively fixed. The virtue of gold was that it was a rare commodity that could not be inflated by irresponsible governments out of all proportion to the supply of goods and services. The greenbackers responded that gold scarcity, far from being a virtue, was actually its major drawback as a medium of exchange. Gold coins might be honest money, but their scarcity had led governments to condone dishonest money, the sleight of hand known as fractional reserve banking. Governments that were barred from creating their own paper money would just borrow it from banks that created it and then demanded it back with interest. Now this is a very short passage and a very smart one. It says, if the yardstick by which value is tallied keeps stretching and shrinking itself, commerce is impaired. When gold was the medium of exchange historically, prices inflated along with the supply of gold. Of course, it's not rocket science. And then again, another discussion about gold, and this is really interesting as well, to be honest. It says, the tether of gold can serve to curb inflation, but an expendable currency is necessary to avert the depressions that pose even graver dangers to the economy. When the money supply contracts, so do productivity and employment. When gold flooded the market after a major gold discovery in the 19th century, there was plenty of money to hire workers, so production and employment went up. When gold became scarce, as when the bankers raised interest rates and called in loans, there was insufficient money to hire workers, so production and employment went down. But the question here, and this is the most important question, is that What did the availability of gold have to do with the ability of farmers to farm, of miners to mine, of builders to build? Not much. The greenbackers argued that the work should come first, and I agree with this. Like in the medieval tally system, the money would follow as a receipt acknowledging payment. Information, that's all it is. Goldbacks argued that there will always be enough gold in a gold-based money system to go around because prices will naturally adjust downward so that supply matches demand. But this fundamental principle of the quantity theory of money has not worked well in practice, ladies and gentlemen. When the money supply contracted during the Great Depression, a vicious deflationary spiral was initiated. Insufficient money to pay workers led to demand falling off, which led to more goods remaining unsold, which caused even more workers to get laid off. Fruit was left to rot in the fields because it wasn't economical to pick it and sell it. And if we as humans have got any brain whatsoever, we cannot let things like that happen. If we created a system that lets something like this happen, then we are far, far down below and behind whatever place we think we are. Seriously. Now, this is just one sentence, but it's very important, and it says, as long as money is lent at compound interest, keeping the money supply fixed and stable means the lenders will eventually wind up with all the gold or whatever it is that we're using. Again, the book states that the problem with the current financial scheme is not that the dollar is not redeemable in gold. It is that the whole monetary edifice is a pyramid scheme based on debt to a private banking cartel. Money created privately as multiple loans against a single reserve is fraudulent on its face. Whether the reserve is a government bond or gold bullion, it doesn't matter. Furthermore, the book says what is threatening to collapse the dollar today is not that it is not backed by gold, it is that 99% of the US money supply is owed back to private lenders with interest, and the money to cover the interest does not exist until new loans are taken out to cover it. Just to maintain our debt-based money supply requires increasing levels of debt and corresponding levels of inflation, creating a debt cyclone that is vacuuming up our national assets. The federal debt has grown so massive that the interest burden alone will soon be more than the taxpayers can afford to pay. Now this part I like very much because it says stocks are not household necessities that shoot out of reach for ordinary consumers when prices go up. The stock market is the casino of people with money to invest. Anyone with any amount of money can jump in at any time, at any level. Okay, I think that's enough reading, although I do have some parts of the book that I would like to focus on if you're planning to read it or if you've read it or anything. So I'm gonna tell you which parts I think are the most important and which parts you should focus on, besides the things that I've just said. So in section 2, chapter 16, there is one part called Challenging Classical Economic Theory that is very much worth focusing on. It doesn't mention countless names or boring details, as is the case with the rest of the book. It actually explains what's important. So definitely pay more attention to it when you're reading the book. Again, in section 2, chapter 17 this time, there's a part called The Real Windfall, and then there's a part called The Magical Multiplying Reserves and To Audit or Abolish. Give those a solid read. Furthermore, there are two parts in section 5, chapter 37 that you need to pay attention to while reading the book. One is called Shipwrecked with a Chest of Gold Coins, another Shipwrecked with an Accountant. So please again pay attention to those as you're reading a book. In section 6, chapter 45, there is a part called The Single Currency Solution that I advise you focus on. Again in section 6, there is a chapter 47, and there is a part called The Puzzle Assembled, which sums up all that was said in the book. So go there, read each point carefully, and then you can just do your own research on the terms and things said there. And this might make it easier to understand the claims in this book. There are a couple of mismatches in this book. For instance, I remember distinctly reading about clients' deposits being there and being available for clients to take back at any moment. And then in other parts of the book, it was stated just as clearly that they aren't there. Okay, another mismatch is right here, and it says, what is wrong with the current system is not that money is advanced as a credit against the borrower's promise to repay, but the interest on this advance accrues to private banks that gave up nothing of their own to earn it. I don't get this. The whole book criticizes the fact that banks create money out of nothing, and suddenly the only thing that's wrong is the interest that goes back to them. Why? Now here's another mismatch. Consumer loans are self-liquidating, they say. The new money they create is eventually paid back and zeroes out. But that result is skewed by the charging of interest and by the fact that the burgeoning federal debt never gets repaid but just keeps growing. Here the problem that I see is that they say that money comes into existence when borrowers borrow from the bank and is extinguished as the loans are repaid. Yeah, from a crazy person's perspective, maybe that's how it looks like. I mean, maybe it is being erased from their books. Balance goes back to zero, if that's the way accounting works. But why does the book focus on that? When the problem here is that money was created out of thin air by the bank. And the key thing is, it ends up being where? In the bank, when it gets paid back. So to me, they created money for themselves, only temporarily giving it away and demanding interest on top of that. And for them, this required virtually zero effort. But for the borrower, oh my god, he'll have to go through hell to pay it back. Work 3 jobs maybe, sell this and that, reduce spending, borrow from friends, and the list goes on. So I wouldn't say that money is being extinguished when it goes back to the bank, only in some sickly accounting system. The more important point here is that it didn't exist, and now it does, in the bank's hands. It just went on a little trip. Do you understand? Just because it came from the bank doesn't mean that when it gets back to it, everything's fine. And then in a different chapter of the book, this thing is being discussed in a different scenario. Here's a quote. The third world debt represents a liability on the bank's books only because the rules of banking say their books must be balanced. So this is pretty much what I just said. It's just the rules of banking. It doesn't change the much more important counterfeiting process here. The longer you read this book, the more you realize that our financial system makes virtually no sense. That it is complex on purpose, allowing counterfeiting and unfair practices. To be honest, this doesn't surprise me, and I've always doubted the reasoning behind becoming a player on the stock market, or everything that's happening on the screen of computers, and the whole investing bug that people have. In fact, I could never understand when people said they wanted to make money even. I usually challenge them and ask what that brings into this world, and aren't they feeling crap because they'll bring in nothing new, nothing good, just become part of the deluded masses. Because really, what sort of aim is it? To make money. If someone outsets with such a goal, there will be nothing good coming out of that. Trust me. I want to look at one more thing, and that is the fact that the book says, the purpose of money is to tally the value of goods and services traded, facilitating commerce between buyers and sellers. However, it's exactly because of the fact that we have this one thing called money that can get us so many other things that people go crazy for it. What if there was some diversification and people couldn't get all the things through just one mean? Maybe then they would actually do all the different things required of them, having no choice, no options to get around the system. Because they know, aha, if I want this, I gotta go do this. If I want that, I gotta go do that. And then for each person, their responsibilities ideally should be suited to their talents, but also contain something that everybody does to maintain peace and equality. And then there should be a time when you have no responsibility, something like vacation, or it could be a time when you just switch responsibilities. Meaning you still do something, but on the creative side, on the educational side. Maybe it would be a time of exploration of others' duties in a community like that. But you wouldn't really need free time or holidays in our current understanding if you've had the life you've always wanted, doing what you're good at, but not 8 hours or more every day. And if certain things like travel to see different parts of your country, continent, or area were implemented in everyday life to make it more enjoyable. If that was the case, then people wouldn't need to escape to an exclusive hotel or to be served and treated like royalty. They probably wouldn't even have addictions, because life would be simple, organized, and enjoyable. Don't you think? Alright, to end this video, I want to read you something that I found online. It doesn't matter what sort of website this is or whatever, but it's a good point to end with. It says, the government and powerful bankers established a system in 1913 that typically works like this. Every dollar of the monetary base comes into existence with a one-to-one increase in the public debt, collectively owed by the taxpayers. Then, private banks use that base to create more dollars that come into existence with a one-to-one increase in private debt. Going the other way, if people in the private sector ever paid off all of their debts and the federal government paid off all of its bondholders, then the supply of US dollars would virtually be extinguished. This is the sense in which our fiat money fractional reserve system uses debt-based money. Although market prices are flexible and can react to deflation much better than most people realize, it is still true that our system is tragically absurd. And I don't think I could find better words for it even if I tried for a week. Tragically absurd is exactly what I would call our present system. And we gotta do something about it, guys.